Anyway, folks, I hope you haven't lost your stomach on this roller coaster ride that has been this earnings season. The stock market has been so unforgiving. If you post good numbers, you're unrewarded. If you post bad numbers, you're going down into the toilet, the gutter. It's over for you. So what we're going to do is review the stocks that I found most fascinating from this earnings period. We're going to take a look at the consumer stapled sector where the dividend investors have been hiding out. And then finally, the next most pivotal earnings for me from the Canadian side of the border with things like Shopify, etc. But we got to roll back a little bit and we've got to salute all the fallen ones. This has been one of the roughest earnings period and just one of the roughest first bear market. I'm going to fully call this as a bear market here, folks. So let's take a moment of silence for those that we've lost. Woo! Baby, yeah, that has been one heck of a disaster over the last year with things like Teladoc, Arc, which is just, her boat's on fire right now here, guys, and even people trying to hide out in stocks posting good numbers can't get ahead. I mean, take a look at this, guy. So Microsoft and Apple arguably posted some of the best earnings that were so ridiculous that nobody could have ever seen them coming. But people are digging around in these things trying to find any hint of bad news, and then forefront that is the story, right? Like, take a look at Apple here. This is funny. Apple shares dip after company warns of a possible $8 billion hit from supply chain shortages and problems. You know what's freaking hilarious about this? They said the exact same thing last quarter. This isn't like new news. So I don't know why they're pressing that as the reason that Apple's going down. I mean, take a look at these numbers here, guys. These are insane. Total net sales for the quarter went from 89 billion to 97 billion. For the, I think that, what is this? Let me move my head out of the way here. We're taking a look for the 6-month end here from 201 billion to 221 billion. This is insane. Nobody knows how Apple keeps doing this. So these numbers should have taken these stocks back toward their all-time highs, but this just really shows you, the bear market, the pressures, the fears, and everything that we're living with. And I mean, even if you're slightly missing or you're still, I mean, these companies are generating huge amounts of capital here. I think a lot of these dips are buying opportunities with things like Amazon, even though e-commerce is slowing down a bit here, guys. They took some more impairment charges on things like Rivian. I don't think it really matters as much, but the stock is still unruly, or the markets are unruly here, dropping Amazon from year to date down 25%. That's insane, guys. These large caps are trading like penny stocks right now. Look at Google here. The only other one to take like a major hit on that earnings period, because Google's down now, 20% on the year. Their PE is now getting back into the teens. And the only thing that got a little bit of life was Facebook, but arguably Google's earnings were a lot better than Facebook's. Facebook came in at the lowest end of their guidance here with I think they came in at 7% revenue growth. The only thing that kept this stock somewhat alive was the fact that they're still seeing growth across their platforms from a user base. But I also think what generally popped the stock off, because this doesn't look like much of a movement year to date, but it's about a 20% movement on the day, right? Which is huge, but largely driven, I think, from a short squeeze that was going on. This stock got so pressured to the downside that I think there was just too much shorting going on. People got hesitant. They closed their short positions, and a lot of people realized, hey, it's not dying. So they bought back into it, which I also think is a relatively good buying opportunity here. But on the dividend side of things, guys, the earnings period was relatively intriguing because we can really see people are hiding out in these companies like Johnson & Johnson, which, they basically are really losing sales to the vaccines and things like that, which caused a little bit of fear. The stock still managed to continue higher this year. So J&J has been a great place to hide out. It's literally one of my largest positions here. I think it's most people's largest positions that are anything related to dividends value. I'd say it's trading at a bit of a premium here, but they're still growing really well. McDonald's. This is one that I've been watching aggressively because I think they had like 800 stores or something affected by everything going on between like Russia, China, a lot of stuff going on globally. But because these are the companies I like because they have really good pricing controls, like Apple, right? Like any company that has full control over specific items in the market that the demand is always there for, they just raise the price, guys. It's just pricing power. It's great. Things like, Johnson & Johnson, McDonald's has this, Pepsi has this, Procter & Gamble has this. So it's no surprise that these stocks have held up so freaking well, right? Because I mean, even read some of the headlines here. Happy Meals, McDonald's price hikes offsets woes in Russia and China. Like they can just literally say, hey, if we're going to get impaired, how much do we have to raise prices to make up for the losses? And they'll get away with it, right? I mean, you're always going to need tampons. I mean, anything hygiene related here, toothpaste, shaving cream, all that stuff. So Procter & Gamble, again, we're not talking about massive growth rates here, but on a 1-year basis, they're still doing much, much better than the general overall market. So what am I paying paying attention to moving forward here? Well, Ryokan being the largest investment in my portfolio right now, or my largest single stock investment, which is posting earnings on May 10th. I don't expect much out of this. This is going to be probably lackluster, boring. That's what I like about my real estate investment trust. I'm collecting a great yield, 420. That's greatly posted there. I mean, I wish this was on April 20th, but nonetheless, we're getting a 4.2% dividend yield on this guy. So this one I'm going to be paying attention to. TELUS is the one that I'm slightly concerned about, with Teladoc getting absolutely slaughtered here, folks. Teladoc, the telehealth sector, I don't know what's happened here. Didn't really look into it. Saw a big earnings miss, all this stuff across the board. And yeah, it tanked on the one day. I mean, just take a look at earnings, down 41% in 5 days alone. So TELUS, I'm a little worried about the telehealth aspect of their business. But this is why I like TELUS a lot, is because they have this fundamental business of just, everything from internet to security, and they're growing with the Canadian economy. So they've never really missed an earnings period based off their fundamental business. So I feel like the telehealth is the cherry on top of the cake, kind of the way I saw, the metaverse with Facebook. But Facebook's underlying business has to remain strong to make that VR stuff a cherry on top, right? Because you want to buy the stability and get the future growth. You want companies that are always forward looking, right? And then finally, Shopify here. Shopify, I don't know. This one could go either way. We're getting Shopify May 5th. By the way, TELUS is going to be on May 6th. Let me know if you want me to live stream these events with Ryokan on May 10th. But taking a look, Shopify May 5th will be the first one to kick it off. And this one, oh my God, guys. This one's been, it's down 73%. This used to be Canada's largest company. And now it's like, I don't even think it's sitting in the top 10 anymore. The market cap is down to $55 billion after reaching a peak of like, what, $140, $150 billion. So this thing is probably going to be the buying opportunity of a lifetime, in my opinion. It'll be really fascinating to see how well big tech's done already. So I can't, outside of Amazon, I don't know. It's just hard to tell if this is closely related to Amazon being a huge e-commerce play. Can it get hit as hard? Nobody really knows. So, this earnings season is basically pointing us in the direction of where everything is going to go moving forward. Now, a lot of you have asked me, how do you feel about the markets now? Like, what do you expect? Well, what I'm expecting is currently we're in a full-blown bearish sentiment, which is usually a good buying opportunity when everyone's negative as hell, even though the numbers aren't coming in that bad at all. And if anything, they're coming out in record rates that we could have never imagined with things like Apple and Microsoft. So this is a good sentiment for buying, basically, because I feel like inflation is slowing down, or it's going to be slowing down. And then on top of that, guys, it's just everyone's so negative all of a sudden when things are actually looking up for once. So for me, I honestly think we're going to see this kind of volatility moving forward a little bit. It should start to nominalize now that we have numbers baked in. But honestly, I can't see you doing any wrong buying in this market. Sure, we can still get some downside, but inevitably, so long as things keep going the way they're going here, in a quarter or two, people are going to wake up to the reality that things are probably relatively fair valued, if not getting into cheap valuation territory. So, I'm liking the opportunity here. I'm picking up stocks, but we'll talk about more on what's going on with that tomorrow. So in light of this, pass the question off to you. What did you guys think about the total earnings season we've seen so far? I'd love to hear about it, but stay cool, stay awesome. And as always, I look forward to catching you in the next one.